Welcome, gang. This is the top tier outlook for the week of April 15. And we are taking a look at our Sunday evening show. If this is the first time you're joining us, welcome to my office. We are kicking off the week on a Sunday evening because this is when I sit down and I start to look at the charts. It's an early look, but I was, as many of you are, very curious as to how the Sunday session, this opening session, was going to begin, given all the news over the weekend. Now, this news was brewing for a while, so let's remember that markets respond to what not necessarily they know has happened, what they fear, what they're concerned, what they think may happen. And the fact that Friday was as resilient as it was, despite what's gone on over the weekend, looks like early look at the Asian session does seem to be pretty resilient. We're taking a look at a pretty stable ES and NQ open. And let's go take a look at gold. A couple things are typically going to start moving when we have any kind of geopolitical strife. And gold would be one of them. In fact, back in my college days, going way back in my college days, when I was trading from the dorm during Gulf One, I did not trade crude. My mentor said, you know what, leave crude alone. The more sure geopolitical thing is gold. Keep an eye on gold. That's going to be where we will likely see the movement. And so I did. That's something I've still stuck with after all these years. Looking at gold during any time of crisis, and crude seems to be actually pretty much stuck in the range that it has been. And, we have to talk about ranges for a moment, and a big shout out to those of you that were with me on Saturday for our top tier outlook class. It's a pretty, I don't want to use the word exciting because it has been difficult action. The price action has been difficult. Quite frankly, very difficult, because the way in which we're dealing with a lot of the concern, not necessarily the newest concern, obviously, of what's happening abroad, but mainly because of the concern that the Federal Reserve is just simply taking too long to clarify their messaging. And I like to just say, at the end of the day, us traders, everything has a season. The best uptrend in the world has a season. It won't last forever. The most strenuous, nerve-wracking, panic-driven downtrend won't last forever either. And neither will this chop. But let's think about where this chop is in sort of the annals of chop. I would have to say, and many of you, like myself, have traded through, whether that be wars, whether that be bubbles bursting, financial panics, pandemics, you name it. I haven't seen chop like this probably since not Brexit, but Grexit. Who remembers the Grexit years? And there were years, a lot of chop. I don't think I've seen this level of chop since probably then. And even then, it's been so long, it's a faint memory. This is significant, beyond typical price movement range. If we take a look at what typically would happen on a Sunday, Monday, Tuesday, Wednesday, what is the typical price movement range? We can study that. We can map it. We can curate the data and then run the math. And by the way, that's an algorithm, right? As much as we talk about algos and everything, that's an algorithm. Whatever logic the machines are running on, and I'm running a machine with logic, it just happens to be price movement range. Whenever we're running that, that's all that it is. The size is obviously going to be a big part of that. And right now we are dealing with a lot of high volatility chop. And as long as this is the case, there's two ways we can measure this. My favorite way is, of course, going to be the daily price movement ranges. And let me get my drawing tools here so I can show you all. I can't wait until we have a top tier outlook or a charts and coffee that we have during the weekday. I can't wait until we're starting up a charts and coffee or top tier session and say, you know what, the price action is trading back within the standard deviations. We still really don't have that. So if you're not really sure what's on the screen, I'm happy to walk you through it really quickly because it's how we define what's happening. So up in here is the volatility highs, right? Or, if you want to be more basic about it, just it's resistance and support. So this is the high, this is resistance, this is the low, and this is support. But this is what happens 68% of the time. So 2/3 of the time, this is where we're going to operate, where price gets into this level, or maybe it gets down into this level. That's 68% of the time. Now, the other part of the time is more extreme. And that's what we're dealing with right now. So that gets us up into the first and second standard deviation of support and resistance. So you can see that this is the extreme. This is the red line, if you will. This is the motor spinning at extreme RPM. So as long as the wicks and even the candle bodies are up in this red section, the red line, if you will, and down here in this area, going beyond the gold zone, going beyond the gray zone, this is far higher than normal volatility. Now, the cool thing about this increase in volatility is when we run the algorithm again, when we run the daily price movement range curation, it will include what's been happening. And we're probably going to end up running that. It's not on a set period of time. We don't like to let it go more than about 3 weeks. But when we see extreme volatility, we can just run it. We can tell the algorithm, hey, time to recalculate, time to recompute, because this volatility has been persisting. Normally, this kind of movement, this extreme standard deviation movement, lasts, frankly, 1 session, maybe 2. But the recent breaks of the movement like this has typically been 1 session worth. We had a time like this in mid-February. It was 1 session. This is now, take a look. If we look at the prolonged period of time, this has been happening since the 4th. This is April 4, right? So this has been happening since the 4th. Today, obviously, is the 14th. How many candles since the 4th have pushed that red line? 1, 2, 3, 4, 5 candles. 5 candles. So like I said, normally we see 1, we've actually now seen 5. And this is where I don't care who you are. There are very few strategies that are going to do well in an environment of such range-bound action. Sure, day trading is going to have a lot of volatility to the up and down side, but anything that's going to be taken overnight is going to be subjected to this up and down. For example, on this day right here, this up green candle here, I'm certain most people thought, all right, the bull market's back. The bullish trend, the bullish sentiment, the bullish momentum is here to stay. And because we were still pushing that upper limit, that red line, I was doubtful. I'm not saying that I knew the next day was going to be an extreme down move, not at all. But we knew we were not out of harm's way. So every morning when I'm in Charts and Coffee, we're going to take another look at this. We're going to take a look at the top tier, and we're going to say, hey, are we still dealing with a choppy market, or has it succumbed to a downtrend? Because we can still map the trend. The trend is remarkably stable. And here's why. One of the things that we do at top tier is he said, look, not every single candle should be weighted equally. So that's the first thing. And then we say to ourselves, all right, of the candles, why would one be important than the other? So we change the way we're placing importance on what is an important candle and therefore heavily weighted, and a lesser important candle and not so heavily weighted. But when we have this kind of choppiness, gang, I'll tell you straight up, it's really difficult to manage because we're so outside the norm. All of us do better with normal price action. And no one, I'm not going to say no one. Some people are going to be day trading very well in this environment. We've had some decent day trades, but the overnight swings are going to be just a pain in the neck. Just a pain in the neck. So that's what we're dealing with right now. Now, if you're looking at how to interpret this, sure. A down candle is going to be the darker shade of green, while the up candle is a lighter shade of green. The down neutral candle is going to be this kind of orangey, dark yellow, while the light kind of sunshine yellow is the up. And the same thing goes with red. Now, we don't have any red candles, and that is very important to note. There are no red candles on the NQ. So for that reason alone, that's relatively speaking less bearish than what we're seeing on the ES. The ES did have a candle that went down, a candle that plotted red. So I'm going to be a little bit more cautious here. The most bearish of the NAS, the S&P, and the Dow is, in fact, the Dow. And this is where we've seen a far more steady string on this daily time frame of the red candles. Now, all my cards on the table. I think that's really important. Not that I want to talk my book, but yeah, I want to tell you what I've got. We went long only the NAS. We went long the NAS on Friday. So I've got a long position in the NASDAQ via QQQ calls in the NASDAQ. I don't know what this is going to look like at 9:30 tomorrow. It may not look anything like this. It may not look anything like this. But right now, we are looking at the daily price movement range and a standard deviation move. So there's my standard deviation move in here. Here's my daily price movement range in here. And we have long calls. We're looking for a retracement of this pretty massive down candle on Friday. So I'd like to just see a retracement of maybe 50% of that move, maybe even a little bit less, and we'll scale out of that. So I would love to see this continue higher through 18.2. We'll see what happens. But we did have to really start to minimize the list of indices that are valid. Now, with that being said, the trading world, our opportunities are a lot bigger, a lot more than just what the NASDAQ, Dow, and S&P are doing. Let's talk about some sectors that don't care at all, really, in terms of what's happening. Yes, huge volatility candle on the XLE, but the trend is still very much intact. We have the XME. This is metals and mining. Looking, again, big candle, but looking very steady. GDX, and this is the trend that I'm focusing on. GDX, again, very steady. And there are some steady sectors. And that's exactly what, it makes sense to focus on the most. Am I going to try to pick a bottom in something? No. We also, while all this is going on, there's massive volatility, we happen to have earnings going on. I know, when it rains, it pours, right? The hits just keep on coming. Take a look at JP Morgan. This is why we don't make bets on earnings. Most of what we do at JP Morgan is use that 642 window, 6 weeks out, 4 weeks out, 2 weeks out from the earnings day. We took advantage of strengthened financials. Once earnings comes around, I don't want anything to do with this, right? Here we have what's been a very strong, great environment. And then as soon as we get within that window to earnings, take a look. I think this is worth mentioning. The trend before earnings actually started to transition to neutral. Now, I'm still going to have generally a bullish bias, and we'll see how this plays out. But please remember, we don't have to play the actual event. We can play the rally up. We can play the anticipation of. We can play the expectation into that earnings event. And that's what I recommend for most folks. I don't play earnings. I don't sell premium, and I don't play earnings in terms of that. So if you're wondering, Rog, we're motoring into earnings season, that means a lot of the cutoffs, those calendar-based cutoffs, are kicking in now for me, and I'll leave those things alone. We'll play the aftermath. We'll play any setups after we get whatever move we're going to get from these. So that's really what I'm focusing on as we're kicking off the new week. So, look, I'm the first one. And let me also make sure I make really clear, because I talk to my members in the mastery, and I know some of you are members and some of you aren't. If you're in the mastery, I love talking about difficult markets and losses. In fact, the Friday video, I said, rough seas make for good sailors. It's true. We don't learn anything in uptrends. We don't learn anything when things are easy. Things are not easy right now. I was actually looking this weekend at the last 2 weeks, right? So remember, on April 4, we had all that crazy volatility. The last 2 weeks have been my most difficult in the last, and I looked back. I wanted to look back and see, hey, 1 year, it was the most difficult the last year. I went back 2 years. Nope, it was the most difficult for the last 2 years. We haven't seen action like this, nor have I seen the kind of difficult trading. I look back 6 years. 6 years. It's been 6 years since this was. You might say, well, what about the pandemic, Rog? That wasn't really as difficult as this, because at least with the pandemic, there was a direction, right? That's what makes this so insidious. But we're still, believe it or not, especially on the NASDAQ, hanging on to some decent support within a market that was up and went sideways. When a market's going up and then it transitions to sideways, the way that I'll look at it is it's bullish chop. Even the chop has a directional bias. It may not obviously have a trend. It's chop. However, it will oftentimes have some directional bias. So, we'll see what we get this week. very challenging times. And this is where we can shorten time frames. This is where we can shorten the time horizon. We will absolutely focus on the dominant trends. That'll be what I spend a lot of time doing in the Top Tier Outlook newsletter that'll go out tomorrow. And then when I take a look at the normalized performance of the last month, of the not month to date, but the last month, I can see here really clearly. Look at what's sitting atop this list. It's gold miners, it's oil and gas explorers, it's energy, it's metals and mining, that's XME. Communication, oddly, is up there, but that's okay. Industrials are up there, utilities, basic materials. And then right at the zero line, and that dashed line right down here, you can see it right there, kind of cutting across. That's the zero line. That's where something has a positive or negative, performance so far, or I should say, for the last month. And you'll see it kind of goes negative once we get to basic materials, but barely negative, and barely negative on semiconductors. And those simply, semiconductors used to be up here. That's where semiconductors spent most of Q1. So if you're looking for follow through in semis, I'll say there's better places now. And this is when people talk about sector rotation, this is what it looks like. And while the current chop is not a characteristic of sector rotation, the fact that there will be certain outperformers, and it was SMH for a really long time, and then XLC, and you'll see where XLC is. It's nowhere near the number 2, and SMH is nowhere near the number 1. This is when we have to say, we know what performed well. We know what helped perhaps grow our account in Q1, but that's not what we're seeing right now. And that's really important, right? It's really important to remember we have to monitor these relative performance, sort of this watch list, this list of strength to weakness, and modify where we're looking for follow through. And trends will always be where the follow through is. And again, there are some pretty good trends in this market, just not in the places that we've seen they were in the previous quarter. And that gets right back to our top tier. So let me move this so we can look at the daily time frame in the whole screen and show you what I mean. So this is the year. Let's look at the whole year. There we go. That's the year. It's not as if the NASDAQ's selling off, is it? I don't even have a red candle. It's not as if we're even making significant lows. This is just high amounts of volatility day after day after day after day. But we're really stuck in a range, aren't we? We're really stuck in a range. Now, it's not so much the way that the Dow is behaving. If someone say, Rag, is the Dow weak? That's completely different. Do you see that? We're not in a range. And the easiest visual cue are those red candles. So I don't have to, it's kind of, this is obvious. This is far weaker, far weaker. Granted, it's probably still chop, but I wouldn't call it bullish chop any longer. It's not in a situation where I'd be aggressively short. Rather than saying, hey, what can we do with the Dow? The question really should be, do I even have to care about the Dow, right? All right, so if I'm prioritizing trends, that's how I'm looking at it right now. So let's take a look at some questions. By the way, you can't, I don't want y'all to miss out. You can't do this alone. You can't do this without some measuring sticks. Maybe some of you all have measuring sticks for this kind of action, volatility, trend. If you don't, come join us in the Top Tier Pro class. The daily price movement ranges, the Top Tier Pro indicators are part of that class. And it'll give you a way to read exactly what I'm doing here in Top Tier Outlook, as well as in Charts and Coffee. I did have a nice break. Thank you, Yi. And I did get your email, Yi. Thank you so much. I will be on the lookout for that. I really had a good time with that class, and it's been a 2-month ramp up from our 30-day trial period in the Sector Secrets Mastery. It's been 14 months of testing these tools because we knew, it's been happening slowly. It was time to go back to the drawing board and say, hey, what is the way that I need to measure what's happening in order to account for what's happening in terms of influence from algorithms, influence from retail traders, influence from 0 days to expiration options, things that we weren't really all that concerned about even just 4 or 5 years ago. So I appreciate it. Thank you, Yi. Question here is where I thought someone asked me about the, and thank you, MBC. It's my pleasure. Look, it's my pleasure. And as I like to say, my job. This is what I've signed up for. This is my life's work. This is what I've dedicated my career to. And I just appreciate that everyone saw value in the indicators in the process. So no, thank you for the time and thank you for spending your time learning that. I never want to take that for granted. As far as what that, this is Koyfin, Koyfin. Yeah, Koyfin. That's what I use for this fantastic service. I don't know the folks there. I think it's an amazing service. It's free. Love that price. We find a lot of cool free tools for our members in the mastery. And this is one of them. Yeah. So this is Koyfin, Koyfin. All right. Next up, Daniel says, I'm thinking about buying the SPY for a day trade. I don't know. Remember, SPY isn't trading right now, Daniel. If you wanted to trade the ES, that would be different. But I'll take a look at the morning and see if there are any day trades in the SPY or the ES for that matter. But the only thing that we could, quote unquote, day trade now would be the Asian session and the futures, right? Or for those of you that trade Forex. So yeah, ultimately what I'm looking at is the relative performance and which of the indices, which of the sectors, which of the individual stocks are holding their own. Google would have to be very near the top of that list. Here's one of the Magnificent Seven acting magnificent, which lately has been quite unusual. What about Microsoft? Microsoft has been pretty darn resilient, right? If you're looking for where at an individual symbol level, at an individual stock level, we've seen resilience and not necessarily follow through to the upside, but buyable moves to support. Microsoft has been absolutely holding its own. Amazon, take a look. We don't have those crazy large candles pushing the standard deviations of historical volatility on Amazon. So those are three really great places in tech to keep an eye on. And then I mentioned that XLC is holding its own. It absolutely is. The number one weighted stock in XLC is Meta. It too is doing a pretty darn good job. So we may not find the clarity we want on the indices, but some individual sectors, some individual stocks. I'll probably, and we haven't looked at tech in a really long time. It's been weeks. I'll probably end up putting a little bit more emphasis on tech as we go into this week. We haven't really done that. I've been focusing on metals, mining, gold, and energy. And while I still will look at those things, probably energy is at the top of that list right now. I got to bring some of these very steady, green, bullish, non-extreme volatility charts back into the fold. Number one, Google. Number two, I'd say Amazon. Number three, Microsoft. Let's keep an eye on those for sure. There are tech that are just dumpster fires. Apple would still be a mess. Apple's still a mess. Apple's still absolutely a mess. Tesla is still a mess. When I say mess, could Tesla have an up day, a down day? Could Apple have an up day, down day? Sure. But when I'm looking at relative performance to the upside, the best bullish structure are in, again, Google, are in Amazon and in Microsoft, and you can even throw Meta in there as well. All right. So those are the things we're looking at. Crude oil has been very resilient. XLE is absolutely worth keeping an eye on. XOP would be another one to keep an eye on, and OIH. These are the common ETFs that have things like Schlumberger, Chevron, Exxon, Devon, Occidental in this group. Be careful because crude sometimes could be subjected to a lot of the volatility, but we will persist where the trends are at least the steadiest. And that's exactly where we need to go. Now, the pool of trending names is about as small as it's been in a long time. We have to accept that. So again, shorten the time frame, day trade, short-term swings. But when we look at direction, there is still some direction out there, just not in the places that were obvious in Q1. And tech is actually having a pretty good run here, especially coming out of last week. And things like financials that I loved for weeks, if not months prior, I'm going to leave that alone. Notice how we've lost the structure. Notice how the trend is gone. Notice how the red candles have emerged. And so that's, again, those are such quick, easy visual cues for the top tier pro system saying, you know what, a little bit more bearishness here than I would like in order to be a bull, in order to be a buyer. And I'll just pass and look for something with better structure. All right. So let's see. As far as, yeah, I just kind of left this question up there. So as far as the day trading goes, Daniel, I'll look at SPY tomorrow morning. We could look at ES now, NQ now, of course, but I'll look tomorrow morning and pay attention to gold. Keep a close eye on crude oil. There's still some good structure to be had here. Just a little bit more volatility than I would like, but we can be patient and let the trades come to us. And in the meanwhile, if all else fails, NASDAQ, Google, Amazon, Microsoft, and maybe even Meta. Disney was on the list for a while too. Disney's been a little volatile. The red candle's shown up, so that might be a later, not a now. So that might be another thing to keep an eye on. All right, gang, as always, thank you so much for joining me for Top Tier Outlook every Sunday at 6. We should go about 20 minutes. Sorry, I ran over a little bit today. I'll see you tomorrow morning for Charts and Coffee at 9 a.m. Same time, well, I should say same channels, 9 a.m. tomorrow. I'll see you then. Enjoy the rest of your weekend. Be good to each other.